The monetary largesse of the major central banks, such as the ECB or the FED, has surely not escaped you. Following the COVID crisis, they have strengthened their interventionist policy and are trying best as they can to save the economy with massive injections of liquidity into the system. We are not talking about hundreds of billions as in 2008, but trillions today. And I'm not even talking about the historically low interest rates. We have reached the point of having rates at zero, even negative in some countries. We must not forget that the interest rate represents the price of the risk linked to a loan, and a compensation for accepting to block your capital for a given period. A loan at negative 1% interest makes absolutely no sense. It would mean the time has no value anymore, and that investing in the future is less risky than keeping your money today. We are walking on our heads. There is no doubt in my mind that the system, and especially the current currencies, are sick. And it is quite clear that they are no longer, and have been for a relatively long time now, fulfilling their role as a store of value. Look, for example, at this graph showing the evolution of the dollar against gold. If you keep your savings nicely in your bank account, it melts like snow in the sun. As Ray Dalio, the famous American investor and fund manager, put it so well,
cash is trash. In other words, it looks like a low-risk thing to hold, but it's not.
And this brings us to one of the fundamental problems with today's currencies. They are not, but really not, difficult to create. Today, central bank policy is based on the ethics and reason of a handful of economists, who try as best they can to regulate money creation through a number of mechanisms to best meet the needs of the economy.
Fair to say you simply flooded the system with money?
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government-guaranteed securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve.
Basically, John Maynard Keynes, often cited as the spiritual father of monetary injections, was talking about short-term, small-scale injections to help in time of crisis. Nothing to do with what we do today. He never advocated turning it into a perpetual group therapy to solve all of our fundamental problems. Our leaders had and still have the power to create money, and therefore use it to sweep under the carpet all the problems they are unable to solve. But today we are caught up with reality. We are no longer wondering if the monetary system will be overhauled at the expense of savers, but rather when this will happen. 10 weeks, 10 months, 10 years? Very difficult to say, but in any case, one thing is certain. Confidence in current currencies like the euro or the dollar is sinking like a stone, and everyone is watching each other, hoping not to be the last to hold the hot potato. The monetary experiment that has been underway for the past 50 years seems to be coming to an end, and the big reset may be closer than we think. And that's where Bitcoin could be interesting. A bit like gold, there's a physical constraint to create new Bitcoins. You can't just press a button or add a line in an Excel file to create billions of euros or dollars ex nihilo. So in this video, we'll discuss Bitcoin scarcity, an aspect that may not be obvious at first, given that it's an open source computer protocol. And yet, you'll see, Bitcoin has all the qualities to become an incredible store of value. Come on, let's go. When you send a message or a picture by email, the file is copied and then transferred to the recipient. The information has therefore been duplicated. This mechanism is obviously not acceptable with money. You can't send $100 to a friend and still have $100 in your account. And that's why there are so many intermediaries in online payment systems today. You may not realize what's going on behind the scenes when you use your Visa or MasterCard at the bar or even for an internet transaction, but it's clearly not something trivial. Between the moment you enter your card code and the moment the merchant receives the money, there are more than a dozen steps in between. All this for what? To solve this famous problem of double spending in the digital age, you are not supposed to spend the same amount of money twice, and the current banking system is trying to make sure of that. All these intermediaries guarantee that the transaction will be carried out as agreed, without a hitch. In late 2008, Satoshi Nakamoto published a white paper that changed everything. Bitcoin, a peer-to-peer electronic cash system. Bitcoin finally solves the problem of double spending, but this time without the need for any intermediary. To understand how Bitcoin accomplishes this feat, you have to dive into its innards. In this case, it's computer code. To be quite honest, this mix of cryptography, computer science, and mathematics is quite complicated, and I won't venture to explain it here. But it works. At least for the last 12 years, Bitcoin allows value to flow across the internet without any intermediaries. Since 2009, Bitcoin has been running like a Swiss clock, and to date, no cases of double spending have been detected. As Apple co-founder Steve Wozniak recently said, Bitcoin is a mathematical miracle. But Bitcoin is not just a payment network, it is also an asset. To distinguish between the two, the community has taken to referring to the Bitcoin network with a capital B and the asset or token with a lowercase b. Basically, only lowercase b Bitcoins can circulate on the uppercase B Bitcoin network. This is completely different from networks like Visa or MasterCard that allow any currency, euro, dollar, yuan, to transit. With Bitcoin, no choice. The network and the token form an inseparable pair. So let's talk about this asset. As you probably already know, there will never be more than 21 million Bitcoins. Bitcoin's inflation rate, i.e. the number of tokens created with each new block, was written into its computer code from the start and automatically decreases every 4 years until it reaches 0 in 2140. In 2009, at the beginning, the reward for mining a block was 50 Bitcoins. Today, in 2021, the reward is 6.25 Bitcoins. In 2024, we will go to just over 3 Bitcoins, and so on. This splitting of the mining reward by 2 is called halving. The mining of new blocks is the one and only way to create new Bitcoins, and to create these blocks, miners must invest a significant amount of energy to solve a mathematical puzzle. This mechanism, called the proof of work, allows for the creation of new Bitcoins to be tightly regulated. Bitcoin goes even further and has a feature that makes the technology truly incredible and unique. The difficulty of mining, or difficulty of creating new Bitcoins, that famous proof of work, automatically adjusts itself according to technological advances to maintain a predetermined inflation rate. It's like a gold gradually sinking into the earth as new mining techniques are discovered. One of the best indicators, in my opinion, to discuss the notion of scarcity of an asset is the stock to overflow. This is the ratio of the quantity available on the market, i.e., the current supply, to the quantity that is gradually entering circulation. The higher the number, the more scarce the asset can be considered. Gold, for example, has an average stock to flow of 66 over the last 100 years, meaning it would take 66 years to double the current gold stock. That's an excellent score. Gold can clearly be considered rare. Now, the stock of flow of gold is bound to fluctuate as gold production varies from year to year, and technological advances could allow in future years the extraction of larger quantities of gold. Especially if the price increases significantly, that would make profitable a certain number of exploitations which are currently stopped. And let's be honest, we don't know exactly how much gold there is in the Earth's crust, or even in the universe. NASA wants, for example, to send by 2022 a probe which should reach in 2026 the asteroid called Psyche-16. The large stone in question would apparently contain enough gold to turn every living person on Earth into a billionaire. Well, of course, gold at the bottom of the ocean or in space remains only theoretical, and for the moment belongs more in science fiction novels. But fundamentally, there is a certain amount of uncertainty and variability with gold. With Bitcoin, it's all about the math. You can calculate with extreme precision how much Bitcoin exists now and how much Bitcoin will exist in the future. If you have fun calculating Bitcoin stock to flow, you'll find that it has almost equaled gold's after the 2020 halving and will far exceed it in the years to come. Bitcoin is becoming more and more scarce as time goes on. Now, I can already hear some people saying, okay, that's nice. But Bitcoin is not rare since its code is free and can be copied indefinitely. Anyone can create Bitcoin 2.0, whereas gold is something unique and you can't copy it. Yes, indeed, anyone can have fun copying and pasting Bitcoin, and there are smart people doing it every day for fun. But to think that these copies threaten Satoshi's invention show a deep misunderstanding of the network effect or Metcalfe's law. Let me explain. You agree that it would be relatively easy to copy WhatsApp or Uber. A small group of experienced computer scientists could probably reproduce the code of these applications in no time. However, just because you have a copy of the technology doesn't mean you've copied the network. In fact, it is very difficult to destabilize a network-based technology that already has a large number of users. When a network reaches a certain size, it becomes almost unassailable. The network effect is the new paradigm of monopoly. Another good example is Wikipedia. Anyone could propose his or her own version of the famous online encyclopedia and launch Wikipedia 2.0. However, even if both platforms were similar in every way, content, design, etc., one of them would have a major asset, its community, readers, editors, developers, etc., to convince users to migrate from network A, e.g. Wikipedia, to a network B, e.g. Wikipedia 2.0. Major and profound improvements should be proposed. As we see in the graph below, the utility of technologies based on Metcalfe's laws grows quadratically with the number of users. If you are the only one with a smartphone, the object has very little value. However, when half the world owns one, the tool becomes revolutionary. The network effect is undoubtedly at its peak with money. This is an area where the best technology leaves no chance to its competitors. This is the famous winner takes all. To better understand this kind of dynamic, imagine 1,000 people speaking 100 different languages traveling in space on a spaceship. After several generations, the crew members will tend to speak one language. It is simply the most efficient way to communicate and collaborate. The same is true for currency. The use of single currency in a group of people, city, country, continent, planet, makes exchanges much more fluid, and therefore appears to be the most efficient solution. This is why, if people have a choice, they will probably all end up using the best currency available. In summary, yes, anyone can copy Bitcoin since its code is open source. However, it is very complicated to replicate the network of users and all the infrastructure that Bitcoin already has. Facebook, Twitter, and Instagram are social networks. Amazon is an e-commerce network. Bitcoin is a monetary network. The second criticism of Bitcoin's scarcity is that there is nothing to stop the community from increasing the maximum amount of Bitcoins at some point. Unfortunately, again, this argument does not hold up for long. Bitcoin relies on an extremely powerful self-defense system based on the economic interests of all its users. And by that, I mean individuals and merchants, but also miners, exchange platforms, developers, and all the companies in the sector. That's a lot of people. For a change to protocol to be adopted, it must go through a series of steps, including verification and testing, and finally reach a consensus within the community, i.e. be accepted by a majority, or ideally even by all participants in the network. If the change proposal fails to meet any of the above criteria, it is rejected, or at least should be rejected in theory. If you decide to make the change anyway, it's no longer Bitcoin, and that's how Bitcoin Cash, Bitcoin Unlimited, Bitcoin Gold, etc. came about. All of these cryptocurrencies share their roots with Bitcoin, but at some point they split up because of their changes in their code that were not approved by the community. This is called a hard fork. Now back to this proposal to increase the maximum amount of tokens. What would be the interest of people holding Bitcoins to allow such a change in the protocol? Honestly, I don't see any. If I own one Bitcoin, I own one Bitcoin out of the 21 million that will exist. If it goes to 42 million, my wealth has just been diluted or divided by 2. I own one Bitcoin out of 42 million. So as I said at the outset, Bitcoin holders are the first defenders of the protocol. And the bigger the network gets, the thicker this protective wall around Bitcoin gets. To conclude, we will try to quickly summarize everything we have said. As we have seen, the current debt currencies are clearly no longer stable reserves of value. The concept of saving no longer exists. Keeping your wealth in cash guarantees that you will become poor over time. The smart ones therefore quickly realized that to keep their wealth, they had to find other assets that could not be created indefinitely. That's why we've seen the price of gold, real estate, art, or even bottles of wine and classic cars skyrocket in recent decades. These are rare assets that are supposed to allow you to protect yourself from inflation. At this point, I hope you figured out that Bitcoin is rare too. The amount of Bitcoins created every year is constantly decreasing, and there will never be more than 21 million tokens. To date, no one has been able to find loopholes in the system to copy or forge Bitcoins. It is this absolute scarcity that fundamentally distinguishes Bitcoin from other crypto projects like Dogecoin, for example, which has no fixed limit. Now, Bitcoin is still a relatively young asset, and the markets are still trying to come to grips with this strange creature. As we've said many times in previous videos, the process of a new store of value emerging is long and complicated. It is the recognition through use that is becoming widespread in a population that makes monetary technology a real currency. But there is no doubt that Bitcoin has enormous potential because it is not based on trust in individuals or on the physical properties of this or that material, but on mathematics. And in my opinion, it is clearly a much higher degree of trust purity than any other monetary technology. Bitcoin is absolute digital scarcity. Interesting, no? Well, I leave you with this punchline. See you soon for new videos. Ciao!
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.